Good afternoon, everyone. Thank you very much for joining this taster session. So this is a short version of a real lecture that I would give to my second year financial mathematics students. You may not know that at the University of Hertfordshire, you can study maths or you can study financial maths. Those are the two options available to you. And I specialise in teaching financial maths. And this is, as I say, a shorter version of one of the lectures that I actually would teach. So it's a good taster for you to understand the kind of thing that you might come across at university if you were to study financial maths. Okay, so the session today is about, is it possible to beat the stock market? And hopefully by the end of it, you'll have more of an idea of whether the answer to that question is yes or no. So first of all, to introduce myself, my name is Carrie Ricketts, and I'm a lecturer here at the University of Hertfordshire, specialising in financial mathematics. Let's get started with this session. So let's start by thinking what we mean by beat the stock market. So this is a graph, and it's the EasyJet share price over the last 1 month. So I'm afraid it's a little faint, the markings on the axes, but you can see that along the bottom is time. So, it moves along the month from a month ago to today. And then the y-axis is the share price. So you can see that the middle line is 1,000, that's in pence, 1,000 pence. And you can see that actually in this case, the start of the month was fairly close to 1,000, just above 1,000, somewhere above that line. And it ended the month just below 1,000. So if you had been investing in this share, if you had bought some of the shares in this company, you actually wouldn't have achieved much return over this month. You'd start with a bit more than 1,000 pence per share, and you ended up with a little bit less than that. However, what you can see is that if you had invested or sold your investment at the right times during the month, you could have made or lost money. So for example, you can see that around the 10th of May, it reaches its peak of about 1,100. So that's 10% more than the start point or the end point. And you can see that there's a low point, a couple of low points, one around the 21st of May and one around the 5th of June, where it goes down to about 950 pence per share. So that's about 5% lower. So for example, someone who bought the share on the 10th of May and sold it 2 weeks later would make a big loss from that investment. So what we're trying to think about is there any way you can predict this? Can you invest to make money when other people are not knowing what to do? And so the words I'm using here are the efficient market hypothesis. And when you understand what that means, you'll see why it's relevant to whether or not we can beat the stock market. So the format of this lecture is going to be, first of all, we'll talk about the definition of the efficient market hypothesis and what I mean by that. Then we'll talk about the implications of the EMH for investors and for analysts. And then we'll talk about the research. So what's the evidence for and against the EMH, whether it exists or not. So starting with the definition, the term efficient market, obviously efficient is a word that we use in English, meaning smart or effective. But in finance, we have a specific meaning of the word efficient. And by efficient market in finance, we mean that the price of every security fully reflects all available information. And so the hypothesis is that security markets are efficient, that the prices of securities reflect the available information. And if you take that a step further and you think if that is true, that means it's not possible to beat the stock market in a consistent and predictable way. Because if all the information about that particular stock is already involved in the price, then that means that the price is sort of exactly right for what it should be. So you can't make lots of profits or a big loss in a predictable or consistent way, although there might still be some random fluctuations from luck and so on. Whereas if the EMH is false, then that implies that if you know some information which isn't reflected in the price, then you could benefit from that information. So we'll talk a bit more about what that means in a second. But first of all, it's important to note that this is a hypothesis, the word in the title, hypothesis. And what that means is it's a proposed explanation, which needs further investigation. And it hasn't yet graduated to become what we would call a theory due to lack of conclusive evidence. So when something's a theory, that means that we are more sure that it's true. I mean, you do have theories that are later exploded and we decide that theory wasn't correct after all. but what it means that at the time when it became a theory, it was generally accepted to be true. The efficient market hypothesis hasn't reached that level. It's still only a hypothesis or an idea or a suggestion. So first of all, just to be clear, if the EMH is true and markets are efficient, that doesn't imply that it's impossible to beat the market. Even in an efficient market, some investors will outperform the rest of the market based just on luck. So we have these random fluctuations going on, and someone will choose to invest at the right moment and choose to sell at the right moment and could make money even if the market is completely efficient. And the example I've used to illustrate that is Paul the octopus. You're probably a bit young to know about Paul, but in the 2010 World Cup, Football World Cup, he became very famous, this octopus. He was a German octopus, and the people who were looking after him would put 2 bowls of food in his tank, each one marked with the flag of the 2 countries who were about to play in the football match. And the bowl that he chose to go to and the food he chose to eat, that predicted which team was going to win. And almost unbelievably, he predicted all 7 of Germany's matches accurately, and the eventual winner, Spain, as well. So I don't believe that the octopus knew who was going to win the football match. So this is an example of how you can outperform the market just by luck alone. However, EMH implies something else other than that. It implies that it's possible to outperform the market in a consistent and predictable way by following a specific strategy. Here's a couple of quotes I found. First of all is Mark Twain and then Warren Buffett. And sorry, I would like to have a slightly more diverse representation, because obviously these are both white American men, but these were the best quotes I could find to illustrate what I was trying to say. So if you read the first one, October, this is one of the peculiarly dangerous months to speculate stocks in. The others are July, January, September, April, November, May, March, June, December, August, and February. So what he's trying to say here is it's completely random. And what he means by that, although he's not actually saying it, is that markets are efficient. You can't beat the market by choosing the right time. It's all just random luck. Whereas Warren Buffett, who's one of the most successful investors of all time, his tip is most people get interested in stocks when everyone else is. The time to get interested is when no one else is. So he's saying that if you predict good performance in a company, you can outperform the market by investing at the right time. The basic concept of the efficient market has been extended to allow for different types of information. So I said that an efficient market means that the stock prices reflect all available information, but that has been extended to allow for different types of information. So what we call the strong form of the EMH, we define information as all kinds of information, whether or not it's publicly available. Then we define the semi-strong form of the EMH, and by this we mean that the information contained in stock prices is all publicly available information. And finally, the weak form of the EMH. And in this we mean that market prices reflect all information that is contained within the historical price data. So in other words, all information that you can obtain by looking at the historic share price from the past few months or years. And this will come back to the difference between strong and semi-strong and weak in just a minute. So if the EMH is or isn't true, let's think about what implications that has for investors. And first, let's just start by defining a couple of different kinds of investors or analysts. You have active fund managers, and they are actively buying and selling stocks and trying to find securities that are currently overpriced or underpriced so that they manage to buy them when they're low priced and sell them when they're high priced, and therefore make money from that. Whereas a passive fund manager doesn't really aim to locate the specific, the strategic targets, which companies are going to do well, which companies are going to do badly. A passive fund manager simply aims to hold a nice, well-diversified portfolio which reflects either the entire market or some subset of the market, and they don't claim to do otherwise. And the active fund manager charges a higher fee because they are claiming to be adding their expertise in terms of which stocks are chosen, whereas the passive fund manager tends to be a cheaper. The fee you pay to invest in that manager in that fund is lower. So we'll consider the implications for the investor. If we believe that markets are efficient, that EMH is shown to hold, then that would be an argument in favour of a passive style of fund management, because it would imply you can't really beat the market. You can't choose stocks that are due to perform very well compared to other stocks. And so it's better just to hold a wide range of different stocks that represent the market as a whole. However, if markets are inefficient, if we can show that markets are inefficient, then that would imply that if you're a good fund manager and you're skilled at picking good, well-performing companies that are about to do very well, and buying them when they're cheap and selling them when they're expensive, then you might be able to perform better than a passive fund manager, because you can take advantage of the temporary mispricing. So for these investors, it would be useful for these investors to know, is a EMH correct or not? Because that implies whether they should choose to invest in an active fund or a passive fund. Another implication is along the lines of, if you're an analyst, if you're someone who advises other investors what to invest in, how should you be doing your analysis? And we have something called fundamental analysis, which means you look at all the information available about a company and you use it to try and predict which companies are about to do very well and which companies are going to fall in price. And so the possible sources of information you might look at would be anything about the company that's published, that's available, such as financial statements, report and accounts, news articles, any information from analysts and rating agency and that kind of thing. So under the efficient markets hypothesis, we're going to try a practice question. Let's assume that the efficient markets hypothesis is true, that markets are efficient and the prices of securities do reflect all the information known about them. Then can fundamental analysis succeed in generating above profits that are above what you would expect, outperforming the market? And have a think. Don't worry if you find this really difficult. Don't worry, because some of my second year students also find this really difficult. But it's just to try and get you to think about what we've just been saying. So don't worry if you haven't got a clue, but just to see if you can put into action what we've been discussing. If EMH is true, if market prices reflect available information under the strong, weak, medium, and some strong, semi-strong, and weak forms, then does that mean that someone could succeed in outperforming the market? So have a go at that question. So for each of the three types of efficient market, strong, semi-strong, or weak, I'd like you to click yes or no. So you should click 3 answers in total. 1 for strong, yes or no, 1 for semi-strong, yes or no, and 1 for weak, yes or no. Okay, so the answer is that if you're talking about the strong or semi-strong type of market, then if a market is strong form efficient or semi-strong form efficient, then someone conducting fundamental analysis of a company would not be able to gain any particular advantage, because all of that information that they're trying to find out is already reflected in the price. Okay, so if it's good information, if it implies the company is going to do well, then that's already reflected in a higher current price. And if it's bad information, it's already reflected in a lower current price. So it's impossible for this person to consistently outperform the market using this information. Then next we look at something called technical analysis. I do appreciate we're whizzing through this because we have such a short amount of time to talk about it. So don't worry too much if these concepts and definitions don't mean a lot to you, but just pick up what you can. So technical analysis, instead of looking at all the information that we talked about a minute ago, like, for example, all the report and accounts and the news stories and published information and that kind of thing, technical analysis simply looks at movements in a company's historic share price. And from that, it tries to predict what the movement is going to be. So it looks at the pattern that's happened over the last few days or weeks or months and tries to tell what's going to happen next. You try to identify trend channels. So you say, oh, it seems to be moving up in this channel, and try and buy and sell when it's at the, sell when it's at the top and buy when it's at the bottom of that channel. Or you try and identify breakouts, which means when the slope of the trend channel changes and suddenly there's a change in the trend of the way that this stock price is moving in. And lots of other methods we haven't got time to go into now: moving average, MACD, Bollinger Bands, stochastic oscillators. Don't worry about all of these, but basically an analyst who is using technical analysis will will generate a buy or sell signal based on all this information. So this is when you imagine if you're seeing a film and you've got a trading floor and people standing up saying buy, buy, sell, sell. This is what they're doing. They're looking at information like this, like the graphs showing on this screen. They're trying to identify the moments to buy and sell purely by looking at the movement in stock price and not considering any other information about the company. So let's do a follow-up question to the previous one. Same question, but now we're talking about technical analysis instead of fundamental analysis. So you've got the three forms of the EMH, and I want a yes/no answer for each of the three forms. As I say, don't worry at all if this is tricky. It is tricky, and lots of people do find it tricky. So I'll just give you another minute to think about that, and then we'll go back to the slides. So to give you the answer to that, and as I say, don't worry if you got this wrong because it is quite a tricky question, but the answer is if the market is efficient, that means that all the information we know about the company is already included in the share price. So under an efficient market, you wouldn't be able to make excess profits. And that is whether it's strong market efficient, semi-strong or weak market efficient. The answer was no in all three cases, because all the information based in the historic share price or any other source of information is already included in the share price. And so therefore, you can't catch it as a bargain at a low point and buy it when it's cheap and make a good return on it, because that information is already within the share price if we believe in the efficient market hypothesis. So we've talked a bit about what we mean by the efficient market hypothesis. We've talked about the definition of it, and we've also talked about the implications of it. If it is true as a theory, as a hypothesis, then what does that mean for an investor or for an analyst who advises people what to buy and sell? So let's turn to the next question, the million-dollar question: is it true or false? We've been talking about if it is true, but I've also said that it's only a hypothesis, not a theory. So that must mean that we're not completely sure it is true. So let's look at the research. Does the evidence support EMH or reject it? So first of all, the strong form of the EMH. So if the strong form of the EMH holds, that means that insider trading would not exist, because it means that the share price already includes all information within it, even information that is only known by people who work for that company, or a small number of people who closely know about that company. So the fact that insider trading is illegal and that there have been some famous cases where people have made money from insider trading is strong evidence against the strong form of the EMH, because otherwise those people wouldn't have been able to make that money. And there's an example from 2007 when someone was convicted of tipping off traders about forthcoming changes in their upgrades and downgrades on stocks, and sentenced to jail. And the tips resulted in millions of dollars of profit. And here's another example, the share price of Partnership, which is a specialist annuity provider in the UK. On the day of the 2014 budget, the share price dropped, as you can see, dramatically, because the UK budget announced that no longer did retired people have to buy an annuity. They could choose what to do with their retirement funds, and that was bad news for Partnership. If the market was strong form efficient, that kind of thing wouldn't have happened to the share price, because because that would have already been included within the share price, that information. So I think most people do agree that the strong form of the EMH is not the case. Moving to the semi-strong form, some very successful investors, such as Warren Buffett, who I mentioned earlier, who use fundamental analysis to identify good investment strategies, provide a challenge to the semi-strong form of the EMH. Warren Buffett has consistently outperformed the market over the long term. And if you believe in the semi-strong form of the EMH, you would say that he should not be able to do that. So again, that's quite strong evidence against the semi-strong form of the EMH. And finally, the weak form of the EMH. So most of the research into the efficient market hypothesis centers around testing the weak form, because this is the form that is most likely to exist, and because it can be tested more easily than the other forms using technical analysis. So earlier we said that if the weak form of EMH is true, if the market is weak form efficient, then that would imply that technical analysis doesn't work. So if you can do some research and show that technical analysis does work, then that would be evidence against the weak form of the EMH. So there's been a lot of research into this because of the potential benefits to investors of knowing whether or not it exists. It's quite a popular area of research and has been for many years. So there have been many papers, I've got some of them here on the screen, but there have been lots of others, have found evidence against the weak form of the EMH. They've spotted techniques that you can use to beat the market. The momentum anomaly, winner-loser reversals, something called the January effect. So that means that companies are more likely to overperform in January, and that if you invest in them in that month, you might outperform the market. However, there are also lots of papers with evidence for the weak form of the EMH that show that passive funds tend to outperform active funds. In other words, technical analysis doesn't work, and that would be evidence for the fact that markets must be efficient. So this is why this is still a hypothesis and not a theory. There's evidence for, there's evidence against. If you look at all the studies that have taken place, the more studies have failed to identify a difference between the returns on securities sectored using technical analysis and those from a random selection. In other words, most studies seem to show that markets are not efficient, and that are weak form efficient, and therefore there's no point using technical analysis to try and choose what to research in. However, despite the overall lack of research-based evidence supporting technical analysis, it's still true to say that it is widely used by traders worldwide. So is it that they know something that the research people haven't been able to show? Who knows? And that's why the jury is still out. None of us are quite sure whether markets are efficient or not efficient. So in conclusion, let's just summarize what we've been saying all the way through this. First of all, we defined EMH. We said that the EMH as a theory, as a hypothesis, proposes that markets are efficient, i.e. that security prices fully reflect all available information. And there are three different types of information that are covered in the three different markets. So you've got strong form efficient, which is all information, whether it's publicly available or not, semi-strong form efficient, which is only publicly available information, and weak form efficient, which is information as defined purely by the historic share price of that security. We talked about the importance of EMH, why is it important, and how it has a lot of implications for the way that investors may choose the right investment strategy, for example, active or passive, and the way that analysts choose to analyze investments and therefore decide how to give advice about buying and selling to investors, and whether they would use fundamental analysis or technical analysis. And finally, we talked a bit about the research behind EMH. And we talked about how there's a large body of evidence both supporting and rejecting EMH, and therefore we haven't been able to reach a conclusion one way or the other about whether EMH is true or false. Excellent. Well, thank you very much, everyone, for coming. I hope you enjoyed the session. As I say, this is I said at the beginning, in case you missed it, this is a real topic that is actually studied by second-year financial maths students at this university. So I hope that did give you a little flavour of the kind of things that you might study if you were to do financial maths or mathematics at university.